yield. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the model. Cliff, man, is that a pretty strong model, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, babies? It's your partners, Dale and Cliff, back in the saddle, always looking better than you. Don't get mad about it, as we always say. Just to deal with the reality of the fineness of what you see. It's all good, baby. Cliff, man, how was Thanksgiving, brother? How things going with the family? Holler at the partner.
Man, it was good, man. Got to spend time with family. You know what I mean? Take a break.
Yeah.
So yeah, hang out with the kid. It's all good, man. You know, it's a good time.
Yeah, same thing with me as well, man. We got to get it in with the family a little bit, man. It was just my wife and I and my two baby girls, man. And we had a good little time just relaxing, man. It was just us, man, which is really good. We like that type of scenario, man. It's pretty good, man. But first and foremost, before Thanksgiving, did we get the bag?
Oh, we got a couple bags this week.
Yes, sir. We got that cash flow back, and we got 4 big ones coming this month. You know what I'm talking about? Apartment complexes, 2 new construction projects, as well as 2 more apartment complexes. So we get in there as y'all hear. My phone ringing. It's all good, baby. Ain't no thing. We'll keep it going. But guys, man, thank you for your time, man. If you could, man, no matter what platform that you're on, please subscribe to the channel. No matter what platform that you're on, this helps our algorithm. You know what I'm saying? So we get a really good content. So we actually ask that you guys can subscribe to us. So, man, we're gonna walk right into this thing, man. You know what time it is, man. Real Estate Friday. So, man, Cliff, brother, you know how we begin this thing every single week, man. You out in the field, boots on the ground as an appraiser. What are you seeing in the marketplace, big time? What are you seeing?
But right now the market's cooling off.
Uh huh.
Right, it's definitely starting to slow down. So
Yeah.
I think this is just the beginning. So it's gonna keep falling depending on where you at. But right now you're not gonna see prices go up. They staying still.
Interesting. So you said pullback. Is the pullback in both the sales and the refinance, or just one of the sectors?
Now the refinance market is almost gone.
It's almost gone. Explain what you mean,
Yeah,
almost gone.
like basically the most of the time you're refinancing for two reasons, right? You're looking to cash out or you
Yeah.
want a better rate.
Hmm.
That's about it.
Hmm.
So the if you're trying to get a better rate, that's gone. That entire market is gone. That's
Ah.
probably 70% of refinances is people just trying to get a better rate. So
Mm,
that's gone.
mm. Because the cost of capital has gone up so significantly. Correct.
Right, exactly. Yeah. It don't make no sense. If you got a 3% or 4% interest rate, why are you gonna refi to a 7, 8%? Don't make sense.
That make no sense. Now, another question, because I got some news from people saying that, well, the Fed has kind of lowered the rates for this month a little bit. And I said, okay. So the question is, what has been the response in the marketplace? And for what you're telling me, the response has been the same: no refinances, as well as no sales. I believe the refinances are down 90%. Would that be accurate?
So it's always gonna change. You know what I
Yeah.
mean? So right now, I still see it continuing, even though the Fed is slowing, but they're
Mhm.
slowing their pace of rate hikes. So they're still gonna hike it. You know what I'm saying? Right? They're still gonna go up.
Yes, sir. So it's like that they are delaying the inevitable. It's going to happen. Get through the pain and let it happen. But for them kind of taking their time doing this, it's prolonging the problem, which is prolonging the pain for a lot of people. And so, with that being actually, and also on the sales side, I've seen a pullback on the sales side and the buying side, of course, cost of capital. Number two, from a sales side, is again, if it costs a new home buyer or an investor more money to acquire property at a higher cost of capital, you're going to see a significant pullback. It's going to happen. I don't know about you. I don't want to pay. I don't want to. I don't mind a discount, but if the cost of capital is 2 or 3 times what I want it to be, am I going to want to move forward with the transaction? Probably not. That's why you're beginning to see you continue to see even more of a pullback on the buying and selling side. Would you agree with the same thing, Cliff?
Oh yeah, because basically it's both problems.
Yeah,
The sellers are in a 4% interest rate, so they don't want to sell.
yeah,
The buyers are buying at an 8% interest rate. They don't want to buy.
yeah, yeah. Is it safe to say, man, that the rental market is getting stronger?
Oh, the rental market is on fire.
Ye-
On fire.
yes, sir,
Because
man.
there's not as much inventory hitting the marketplace, especially for
Mm,
single family. Because what's happening is there's not enough units. Period. We don't
yeah,
have enough
yeah,
housing, right?
yeah. Mm,
And sellers aren't selling.
yeah,
And if sellers
yeah.
aren't selling, buyers aren't buying. You gotta live somewhere. You renting.
So it sounds like, so to answer the question, have the home prices cooled down? Yes, it has. And just to kind of let you know what's going on, guys, let me bring up CNBC. They actually have something that says home prices cooled down at a record pace in the month of August, which is pretty crazy. It says it's down. It says this is down 15.6% annual gain in from the previous month. So how you kind of gauge gains is on an annual basis. It's down 15.6%. That's crazy. Would you agree, Cliff?
Yeah, yeah. That's a big. Put it this way: we have not lost any appreciation in what, like probably around 2000, depending on where you at, 2010, maybe
Yeah,
11.
yeah,
So you've
yeah.
had 12 years of appreciation.
Mm-hmm. Mm-hmm.
And so this is the first time we're getting a pullback in real estate right now. And most people are
Yeah,
not used to it. They're not used
yeah,
to this.
yeah. I agree. Most people are not used to it at all, but I always say that the success that people actually had before was fake success because it was kind of
Mm,
manufactured. The reason why is because I believe that the rates were kept down for too long of a period of time. Really, the sweet spot when it comes to interest rates, as I believe, is between 6 to 8% in a stable economy. We were at 2 or 3% for a long period of time, which was unhealthy for our economy, and it really created this inflationary standpoint with lower rates, which is I like lower rates. The more demand goes up, and the more money is flowing through, and people begin to see this kind of a fake success because it's being kind of manufactured because of these lower rates. Would you kind of agree with that, Cliff, or not?
yeah, the low interest rates is like sugar high. You know what I mean? It's just
Yeah,
it's fake. It's easy. But at some point you're gonna crash when you on it.
yeah, yeah. And this is coming from CoreLogic, guys. CoreLogic is what a lot of the news anchors use. Now let's go to the second one, Cliff, real fast. I'm gonna go over here. How much equity, man, the has the homeowner lost?
Man, they lost at least a trillion. You know what I mean? Trillion. Because if you pull them back, like you saw, it's about 15%. I was about to say 20. And
Ooh,
if you on the coasts, East Coast, West Coast, you dropping probably
ooh,
maybe even 30, 40%.
ooh, man. I'm glad you said that, Cliff. Let's go back to the news, man. Here we go, guys. The news said it best. It says homeowners have lost $1.5 trillion in equity since May as the housing market continues to decline. $1.5 trillion, and I believe it's going to get worse. This is nothing. 1.5 trillion is nothing. Q2 or Q3 of next year, it's going to be, in my opinion, it's going to be, and I hope I'm wrong. I hope I'm wrong. It's going to be a bloodbath because the Inflation Reduction, I call it Production Act money, which is $6 trillion, has not hit the market yet. It hit in 2023. Where's 6 trillion going to? Where's it going to go? It's going to cause some more inflation. So I call it the Inflation Production Act. If that makes some sense, man. Man, Cliff, man, let's keep it going, man. What cities, man, should investors invest in your opinion?
For me, it depends on what you're trying to do, right?
Exit strategy.
Right. If you're trying to flip, then you're probably looking at areas that still have strong demand. So you're probably looking in the cities, right? You want cities, great neighborhoods,
Yeah.
right? Those are flipping areas because they still got good demand. We got good school districts, right? I mean, it's basic fundamentals real estate. Location, right? So if you got a good location, then you can flip out there all day and you can still be all right. But that's where you be in your cities, you know, like Austin, Miami, you know what I mean? You can go different areas like that, you know, Atlanta.
Yeah.
Those are still good areas. Now, if you're looking to rent, I'm going to tertiary markets, right? I'm going to them secondary markets. I'm looking at Oklahoma City. I'm looking at Kansas City. You know, places up in Michigan, Ohio. Those are great spots. I was talking to Dale this week about possibly going to Chicago.
Yeah, South Side. I was like, hold on, wait a minute. Hold on, wait a minute. You're talking about we gotta get a squad together. They can handle that whole situation. You know what I'm talking about? But it's about dollars and cents. But again, when it comes to that context, it's about some sense too. So we didn't have a team there on the ground in South Side of Chicago. So we have to make sure we get that thing right. But I'm not opposed at all to investing there. All right, guys. Now, I agree with Cliff. I'm a holding guy. I very rarely flip. And so for me, those mid-tier areas, and of course, I always say Killeen, Temple, Diboll, and these are cities in Texas. Lufkin, Centerville, maybe some outer areas of Dallas, Holton City, Arlington. Arlington, Texas is very untapped. Fort Worth is very untapped. I'm confused. A lot of investors flock to Dallas. They don't go over to Tarrant County, which to me is kind of odd because Tarrant County is ripe. There's really nobody over there. Would you agree, Cliff?
Man, yo, the gold is in Tarrant County. South, if you really want to get into it, I probably had about 5, maybe 6 properties in South Tarrant County. I mean, you talk about great rental properties, easy flips, good prices. It's in South Tarrant County. Like they got, I flipped like 5 houses out there. All of them are sold quick.
We talking about Euless, Haltom City, Keller. Let's see what's out there. Of course, Arlington. Some areas of Fort Worth as well, man. Those areas, man, it is severely untapped. So if you are a real estate investor in the Dallas-Fort Worth area, or you invest remotely, begin looking in the Tarrant County area. It is so right for investors, all right? So right, whether you want to buy and flip or buy and hold, all right? It's real simple. Now, this is what CNBC said when it actually came to these cities, okay? They said these are the top fastest cooling U.S. housing markets. Cooling mean that ain't nothing happening. This is where a lot of the pullback came from. This is based on their assessment. San Jose, California, Sacramento, California, Oakland, California. Notice where we at. Seattle, Washington, Stockton, California, Boise, Idaho, Denver, Colorado, San Diego, California, I'm sorry, Tacoma, Washington, San Francisco. Notice where we're at. That's the West Coast. West Coast. Okay. Now, in their opinion, guys, this is what they say when it comes to the top slowest cooling areas. And I kind of disagree with them, to be honest with you. Albany, New York. I would not invest anywhere in New York. This is not gonna happen unless the deal is killer, because they have some of the worst laws when it comes to lenders, lenders as well as landlords. El Paso, Texas. I do El Paso. Connecticut, Bridgeport. I do Connecticut. Lake County, Illinois. Suspect. Rochester, New York. Suspect. You know what I'm talking about? New Brunswick, New Jersey. Suspect. Cincinnati, Ohio. Okay. Akron, Ohio. It depends on the area. All right. New Haven, Connecticut. I'm rocking with you. Virginia Beach, Virginia. Yes, and maybe no, because Virginia can be a little bit inflated as well, but it's close to Washington, D.C. And this is Washington, D.C., the money seems to always flow there. And so some of these cities I agree with, some of these cities I don't. But for me, I like the Southwest United States.
Yeah, yep.
Arkansas, Mississippi, Tennessee, some areas of Texas, some areas of Louisiana, Georgia, those type of Florida, North Carolina, South Carolina. It depends on those areas, those mid-tier areas, because there's not a lot of competition there. I mean, Mississippi is extremely untapped. The state of Mississippi. So I'm giving you guys some game. You agree, Cliff? Holla.
Yeah. I agree. Like, it depends what you're going for. So I'm following what Dale's saying when you're talking about getting rental properties,
Mm-hmm.
right? But I like to split my portfolio up. I want some rental properties for the most part, and then I want a couple of appreciation properties.
Mm-hmm.
In the rental properties, I'm down with you. I'm going to the South. I may go Midwest because I'm not looking for appreciation. I'm looking
Yeah.
for rent.
Yeah.
So I'm okay with if I buy a property this year that in 10 years it only went up 20%, 15%.
Yeah. Yeah.
I'm okay
yeah,
with that
yeah,
because I get strong rents.
yeah. So, Cliff, we kind of gave them some bad news where we are when it comes to the real estate economy, which I think is wise to do because we're in a changing economy. It changes on the fly. And so our plan has to be able to be really fluid for us to begin to change on the fly as well. So, with that being stated, uh, what should be the next move for investors, in your opinion?
I would say start putting your team together, your power team, and get ready to buy. This next year, I'm buying. Oh, you just showed some information earlier, right? The market's cooling off, interest rates are high, there's not much inventory. What that tells me is the market is at a point where you can buy at a low.
Discount. Yes, sir. Discount.
Right.
Yes, sir. Yes, sir. I agree with that, and I'm gonna bring this news up as well, guys. I don't know if you guys saw this as well. I want you to see this. Blackstone controls about $15 trillion worth of funds, assets under management. In other words, is AUM. If you have a retirement account, whether it be a 401k, IRA, Roth IRA, 403b, whatever, pick one. They actually control it. Because of the pullback we were talking about, BlackRock really got into the real estate space because of the fact that they could buy whole subdivisions uh, 25 to 50% over the asking price. They did that. They did that in Forney, Texas. Okay. Well, if you look at it because of the pullback, Blackstone, which is another word for BlackRock as well, to limit withdrawals from $125 billion real estate fund. They're beginning to limit them. Now, they paid some of this out. They did. But because the ask of investors have been coming, they said, we got to limit this. Why? Because it's a volatile market. So you're seeing on a expert level the same pullback. So we're not giving you guys smoke up your ass. This is exactly what it is. Exactly what it is. All right, guys. Now, to kind of take that down real fast, for me, what should be the next move? I always say this here. Number one, real estate investing can be a very sexy business. Okay, because all you hear is buying, flip. The lion's share of marketing is in the buying and flipping marketing, and that's fine. I think this is a terrible market to flip in. I think it's a horrible market to flip in because who's going to buy it from you at what cost of capital? Didn't make sense to me at all to buy and flip. That's just my opinion. I think this is a prime time to hold. Okay, so first and foremost, if you have your money in these retirement accounts, get it in the proper environment. Consult your wealth manager to understand what that environment should be in. Number two is if you are a passive investor, look at taking control of your retirement funds and you investing into a fund that's in real estate for you to begin to generate a passive income. Okay, you by doing that, you decrease your liability, you decrease your tax liability as well, but you increase your return on investment. Okay, and you insulate it fairly cool. If you want to be active, I will copy the exact same model, but instead of investing to a fund, you begin to really invest into real estate courses that can teach you how to navigate these new volatile times, to really invest in yourself so that you can begin to understand how to get those discount properties. Let me ask you this question, Cliff, and I ain't gonna brag on us. Yeah, I am, because it's us. Um, do we ever really market at all for discount properties, or do they just come to us?
I mean, a lot of deals just come to us.
So if that's not your reality, guys, and that's because of the fact that we have a good name in the marketplace, we have a pretty big balance sheet, and we have cash in the bank. If that's not your reality, you've got to figure out how can you make that your reality. Okay? And that only happens when you actually begin to invest in yourself, if that makes some sense. So, Cliff, you want to add anything, man, before we close, big dog?
Not just, I would start looking right now. I would start focusing on rental properties,
Yes.
because you got to understand rent follows interest rates. If interest rates are high,
Yeah.
rent is high. So if they've just been raising rents, or my bad, raising interest rates over the last 6 months, and they're going to keep raising them, now you can get in on that wave, and rents will start going up because the investors buy properties mostly to rent. And if our interest rates are high, we have to pass that off to the renter. You see what I'm saying? So rents are about to explode the next 2-3 years. You're going to see rents just jump up again.
Yes, sir. Yes, sir, man. Yes, sir. Guys, man, that's really all I realistically had for today. But I want to give you guys a sneak peek of something. And so it's going to be real quick sneak peek. And then you'll see a complete peek of it right after this is done. So don't get off too fast, because you're going to miss that blessing. Here is a sneak peek. I want y'all to see something real fast. Cliff, does this look familiar, man? Does this look familiar?
Yeah, I see our education.
Yeah, let me bring it up real fast. Y'all, this is the real estate website, guys. They go to Cash Flow Club, guys. They go to Cash Flow Club. This is the preview portion of it. Here are 3 of courses. 3 of the courses, guys. This goes live today. It goes live today. So you guys have been very patient with us concerning the course. We got it done. You see 3 right here. You'll see another probably 7 later on today, guys. And so we had to kind of re-record some additional things. Cliff is currently working on another one of the courses as well, and he goes deep into the training concerning how to price out goods. I mean, this guy's going to be literally walking through Home Depot and or Lowe's or Service and Surplus, so we can walk through the cost of goods. It's very important now moving forward with the increase in cost of goods going up. You have to be able to negotiate in a way to where you keep your costs down, so that you have that arbitrage of yield there. Would you agree, Cliff?
Right, exactly. Yeah. Give you the information you need in order to start making good decisions.
Yes, sir. Here is, but that's what it realistically is, guys, man. You'll see the live one. You're going to see the live one later on today, guys. Later on today. So stay tuned to the end, and you'll get a live kind of walk through what it is. Okay, guys? But Cliff, man, that's all I have for today, guys. Again, guys, thank you for your time. I hope you added some value to you today. All right. I thought it was wise for us to kind of revisit the changing in the market, because it happened so quickly. But at the exact same time, man, I think that was wise for us to do that. Well, Cliff, man, you have anything you want to add to us, man, before we leave?
No, like just what Dale was saying. Keep looking out for some new deals. look at our education, try to learn some things, and start making offers.
That's it, guys. Well, guys, before you leave, and while you can, take the damn picture for your mama and them, and add your grandma and them to it as well, because you got to see us. Now holla at your partners. All right, y'all.